Good afternoon. Welcome and thank you for everyone for joining today. We're excited to share our experiences around the value of in-house banking for Treasury. My name is Jeff Engelhart, and I'm joined by my colleague Karen Willis. Before we get started today, I do have a few housekeeping items. All attendees have been placed on mute for the duration of the presentation. If you have any questions, please do submit them through the portal on the right-hand side of your screen, and we'll take time at the end of the presentation to answer any questions that you guys may have. Also, we have a series of poll questions today that do require your participation. Answering these questions helps us better understand and cater our webinars to make it most applicable to what you guys want to see. A copy of today's presentation will be sent out in the next few days following the webinar. And because this presentation is certified for CTP credits, the attendance documents for that will also be included with the materials from today's presentation. Lastly, any of our past Elire webinars, as well as today's recording, are available on the Elire Inc. YouTube page, as well as Elire.com. Welcome you guys to check that out. So to get started today, I'd like to introduce who you have on the call today from Elire. My name is Jeff Engelhart. I'm on the business development team here at Elire, and a little later I'll share more about what it is that we do. Karen, would you like to introduce yourself?
Hello, everyone. This is Karen Willis. I'm a founding partner of Elire. I have 25 years in the finance industry, 20 of them specifically in Treasury, and also a CTP for 20 years.
Thank you, Karen. For today's agenda, we'll walk through Elire introduction and our industry experience in a little bit more detail. And then Karen will really drive into the meat of today's conversation as it relates to in-house banking, giving a general overview, followed by what an implementation would look like of an in-house banking solution. That will include considerations, goals and challenges, as well as implementation strategies that Karen and her colleagues have deployed. That will be followed by post-implementation benefits, as well as final regulation highlights for the S385. And then again, we'll leave some time at the end of today's conversation for any questions that you guys may have. So to tell you a little bit more about Elire, Elire is the industry leader in ERP Treasury solutions. Elire has been around since 2005, and it's continued to be one of the go-to Treasury consulting firms in the country, with over 200 Treasury workstation implementations, as well as experience with over 40 Fortune 500 clients. As you can see on the right, we are an Oracle Gold Partner, Cloud Standard, Swift Ready Services Partner, as well as a proud member of Quest. One key practice area that I want to share a little bit more about on the next slide is our Treasury Advisory Strategic Services Group. As you can see, some of our service offerings here within our Treasury Advisory Services Group, this team is system agnostic and will work with our clients as it pertains to Treasury roadmaps, deep business process mapping, Treasury transformation, similar to today's conversation with in-house banking, cash pools, global liquidity, and so on, as well as RFI, RFP design as it pertains to banking relationships, Treasury management system selection, so on and so forth. So on the next slide, before I hand it over to Karen to really dive into the presentation today, just to kind of give you guys a snapshot, we call this our NASCAR slide with some of the logos of some of the clients that we worked with, as you can see, spanning across multiple different verticals: healthcare, government, higher ed, manufacturing, retail, all of the above. So with that said, I'd like to hand it over to Karen to jump right into the content of today's conversation, which is in-house banking. Karen?
Thank you, Jeff. I want to share with you the different industries where our team at Elire has implemented in-house banking. So you can see it's very diverse. The utilities, insurance, healthcare, hospitality globally, automotive globally, securities firms globally, and real estate global. I wanted to start with an actual model from one of our clients. This would be a typical IHB configuration across the globe. So this particular client had a Treasury center in New York and also in Luxembourg for the European IHB. In addition to the centers, it also requires a regional treasury configuration so that areas such as Asia out of Shanghai and Brazil in South America are covered. The New York office and also a Frankfurt office were regional treasury centers as well. You can see from the red dots that there are various bank account locations throughout other areas that are managed by those regional treasury centers. So this would be a typical configuration for bank accounts and centers across the globe for an IHB. The organizational structure for an IHB, again, this is the most common configuration, not the only configuration, but typically corporate treasury would continue to handle the CFO global cash, credit facility, global banking relationships, macro hedging, risk, insurance, and then, of course, technology. And technology is an important one that we'll talk more about later today. The international treasury is a key component. They are typically the primary manager of the in-house bank. They would also handle international liquidity and investments, FX trades for the pool and hedge management, the primary administrative oversight of the cash pool. So for transactions, setting market rates, global intercompany settlements. They also would manage the international forecast and POBO relationships for third-party vendors, so payment on behalf of. Intercompany multilateral netting would also be handled by the international treasury and also international merger and acquisition due diligence. Regional treasuries continue to be needed in this scenario for in-country cash position and liquidity, and also for additional forecasting for a specific country. And regional vendor POBO is often still run out of regional treasuries in country.
All right, that brings us to our first poll question of the day. Number one, how is your firm's treasury organization structured today? I'll give everybody a few minutes. Please only select one option, and we'll go from there. All right, if you have not voted, please do so, as we're going to be closing it out here in a couple of seconds. All right, thank you for everybody that participated. It looks like the majority of the folks on the call today we would say they would operate in a decentralized globally as it pertains to their treasury organization today. That being said, I'll hand it back over to Karen.
Thank you, Jeff. So under an IHB scenario, there are changes that occur with respect to internal loans. Under the IHB, loans essentially between the business unit and the cash pool become overnight loans. They are typically denominated in the business unit's functional currency. It can be in other currencies as well, but typically, most commonly in the functional currency. All entities typically have a master deposit loan agreement that they place with the IHB, and benchmarks such as LIBOR are used to accrue interest. Intercompany loans that occur from corporate to the business unit, once an IHB is implemented, those become simply term loans if an overnight loan from the IHB cannot be placed. So there are some special circumstances or some long-term capital lending that is handled by the term loans. Intercompany loans between two business units, those are typically minimized or excluded altogether because those lending situations are replaced by overnight loans with the IHB. The chart below shows some of the core elements for the IHB. The internal bank or banks need to be established. This is an internal business entity, and they become the nominal pooling or funding unit. Of course, you still retain your external banks, your regular financial institutions where there are some physical wire transfers that continue to occur. The internal bank account becomes a bank account with nominal funds between the IHB and the entity. So they are managed very similar to a standard external bank account, which the entities continue to hold with the outside institution. The current account is referred for the external physical operating bank account. However, it's often used to refer in the IHB scenario to the primary currency relationship or internal account that the entity has with the in-house bank. The chart below shows an actual structure with one of our clients. The in-house banks were set up strategically on a geographic basis just to correspond with the primary banking relationships on an external level. So IHB 01, 02, 03, there were 4 different in-house banks in different currencies with the exception of Euro where there were actually 2 pools established. And you can see that each of those related to an external bank. In regards to the in-house bank pool structure, there's both a nominal structure and a physical structure. Under the nominal structure, the in-house bank pools are typically in USD, Euro, and GBP. They can be in other currencies according to an individual company's needs. Those are the most common. In the nominal structure, netting of intercompany, accounts receivable, and accounts payable is naturally achieved by the flows that occur within the IHB pool. The IHB then holds and calculates a daily position for each of the pool participants in their nominal account. FX trading is typically handled at the IHB pool level by the IHB pool administrator. Non-deliverable functional currencies, or NDFs, can also have accounts within the IHB pool on a nominal basis. It's just that they're not settled physically like other currencies. There are restrictions for some countries that cannot participate. There are concerns with Italy and Poland, so there are some exceptions to these structures. And the nominal pool structure significantly reduces the number of physical payments and fees associated with those physical payments that occur on a daily basis. The physical pool structure is still needed. They include the daily sweep transfers that occur within the pool. There's IT technology that is needed to support those sweep transfers, concentration transfers, on an automated basis in order to make the in-house banking efficient. Some currency holdings must remain in country. We have encountered issues in China and Russia, for example. And as I mentioned, the NDF currencies will not participate in the physical portion of the pool transfers.
Thank you, Karen. That brings us up to our second poll question. And similar to the first poll question, we'll leave this open for a little bit, and please select only one answer. Question is, what type of cash pool structure do you use today? 1, nominal only, 2, physical only, 3, a combination of both, and 4, currently no cash pools in use. All right, and if you have not got a question in, please do so, as we're going to be closing this out. All right. It looks like half of the group is using nominal only currently, with another quarter of the group using a combination of both physical and nominal. Karen?
Thank you, Jeff. So the chart below simply shows that in an in-house bank configuration, there are the external cash flows, which are for the physical accounts. There are also internal cash flows for the nominal accounts within the structure. You'll notice that what's different about the internal cash flows is that we have the IHB pool bank through which the internal cash flows will move. The chart below shows the same structure with just a little bit more detail. The primary point here is that with the external cash flows, there's a simple debit and a credit. With the internal cash flows, all parties within the pool need to have a position maintained because we do have a daily position that's calculated on which interest is then calculated. So because of that, there are flows for Business Unit 1 and Business Unit 2, which emulate the external cash flows. But there is then another flow with the in-house bank. You'll notice that those flows are positive and negative, and they will be equal in amount. So the overall position for the IHB will be a net zero, stays in balance. The following example is again a real client that we worked with who had a corporate entity in Europe with their primary banking relationship with Deutsche Bank in Frankfurt. One of the issues that they encountered that they wanted to solve with the IHB is that they had a local business unit in Canada who could not request funding after 9 a.m. Eastern Time. This was a very big operational and cash flow issue. Once we established an IHB, there was a corporate IHB pool established in the Canada region, and the BU in Canada was now able to request funds from the pool up until 5 p.m. Eastern Time through Deutsche Bank in Toronto. So this reduced the funding turnaround time from 2 days to 1. This is just an example of the kinds of efficiencies with careful geographic planning of the IHB pools that you can achieve. IHB implementation considerations. IHB is a significant undertaking. There are many issues to consider. There's tremendous benefits to the final outcome, but when you are implementing, there are many components to look at. The first is policy changes. There's often many discussions that need to occur around internal lending agreements and how they'll be managed, defining minimum operating cash, how much will be swept from each business unit to the pool, and then investment policy in order to allow investing in multiple currencies. Resource requirements is a very significant concern. Regional Treasury centers need to be established throughout the globe for efficient processing and efficient concentration and efficient payments within the structure. The BUs in the IHB pools need to work within the same time zone. In addition to that, system requirements are very important, and we'll talk a little more later about system requirements. So when planning the IHB, the bank account locations need to be reviewed according to the geography and the needs, and it's very likely that you may select a new global bank with more capabilities around cash pooling and around the support of transfers, such as the ISO 20022 transfers. And in addition, ideally the company and the business unit hold accounts in the same bank to minimize wire fees and transfer fees. Daylight credit arrangements may also need to be put in place or renegotiated as part of an IHB pool scenario. In the sweep bank account architecture for the IHB, the most important component is that all cash above a designated or agreed upon target balance will be swept into the cash pool. So that's typically worked out between the IHB administrator and each business unit that's participating. And there needs to be awareness as to the deliverable functional currencies versus the non-deliverable functional currencies, which cannot be swept. Multilateral netting plays a big component in IHB. The IHB itself has a natural multilateral netting function within it just by virtue of the cash flows between the different entities flowing through the in-house bank and creating an overall position. That is done before physical transfers take place. So a very large reduction in the number of transfers typically occurs once an IHB is implemented. One of the important pieces is that software needs to support that netting within the IHB and also needs to provide that daily position on which interest is calculated.
Thank you, Karen. That brings us to our third poll question. This one is a little bit different than the first two, so please feel free to select as many applicable answers that you see there. What is your firm's strongest impediment to implementing an in-house banking system? 1, policy changes in tax. 2, resources in proper time zone. 3, opening new bank accounts in geographic locations. 4, daylight credit capacity restrictions. And 5, none of the above. See quite a few answers coming through. Please keep them coming. We'll give you guys a few more seconds. All right. Some last minute shifts there in the percentages, so thank you for getting your answers in. It looks like the majority of the people on the call, actually none of the above as it pertains to some of the challenges implementing an in-house banking solution. So I'll hand it back over to Karen to talk through the goals and challenges as it pertains to in-house banking.
Thank you, Jeff. So when implementing an in-house bank, the primary goals are maximizing the invested funds in the preferred currencies. So this allows you to capture excess cash around the globe, bring it to the pools, and then have more funds available for investment. It also, through the design, tends to streamline the number of international banks, currencies, and the number of accounts that you have. Also allows optimal global FX management. So larger block trading can be done at the pool level, and then those funds are reserved for operating needs for the entities as they need it. Also, it tends to consolidate long positions in currencies, which are used first before actually executing trading. There is also an opportunity to perform more of a macro global FX hedging analysis and to take macro hedge positions. Challenges to an in-house bank design or implementation really focus primarily first on corporate tax and advisors that must validate the IHB entity structure. It is most common to dedicate the IHB physical presence in Luxembourg, and that has to do with tax policy and a number of advantages that that country provides. It's not the only place they can be located, but it is the most common. Complex documentation can be required, and that is all related to typically the tax issues, legal, and audit issues. Complex configuration around technology solutions is also required. There's many moving parts within an IHB. The fact that there's a physical structure, a nominal structure, and there is this mirroring effect of the cash flows within the IHB does require a solid technology solution to help you manage. And there are several of them out there. Centralized and decentralized may still be required depending on your corporate structure for some entities. And you may already have pool structures in place which you don't want to disturb, that you want to incorporate within the in-house bank and expand upon. So strategies that are typically used in an in-house bank implementation, first, as I mentioned, the European IHB is typically established in Europe and most commonly in Luxembourg. A number of our clients also have them established within the Netherlands. USD domestic IHB is typically separate from the European IHB and located in the US, obviously most commonly located in New York, for example. I mentioned earlier the most common currencies are Euro, USD, and GBP, but it's quite reasonable to utilize other currencies such as CAD, for example. The business unit entities, as they participate in the IHB, they will actually hold accounts, internal accounts, in their local in-country currency. However, one entity could have their primary in-country currency and possibly a secondary currency. External cash within the IHB should really only be moving primarily for funding and concentration purposes. So the number of external cash flows should go down very significantly. Some entities, and this goes to the advisors and tax challenge, some entities may not borrow from a foreign IHB, they may only lend. So those restrictions need to be clear when you're designing the IHB. Asia-Pac region is often not in the phase one scope due to regulatory complexities and non-deliverable currencies. Additional strategies, the IHB internal banks, pool banks, handle the FX trading for their respective pool structure. Pre-netting is sometimes required for intercompany AP and AR obligations, so payables and receivables intercompany, and this occurs if volumes are too excessive to run individual flows through the IHB. But most commonly, the volume is low enough that you can use the inherent natural netting within an IHB pool just as it is. When IHB accounting transactions occur as a result of those flows, the system that supports this process needs to be able to record those flows into multiple ledgers. So typically we're looking at a multi-book, multi-currency ledger situation because there's typically a corporate reporting or corporate functional ledger and then an international local ledger in the in-country currency. Internal transfers should use the corporate daily FX spot rate. And the reason for this is they will be consistent with the revaluation policy for currencies within the general ledger and minimize foreign currency gains and losses. For external transfers, because they're typically negotiated with your banking counterparty, those rates are typically different than the corporate spot rate used in the ledger, and there will be gains and losses that do occur. Automation is critical. The TMS software that you choose to support the IHB is very important. The next two charts are provided for your use after the presentation. These are designed in such a way to give you means of analyzing the ROI benefit from impacting an IHB.
All right, and that brings us to our fourth and final poll question of the afternoon. This one's similar to poll question number 3. Feel free to select as many answers that apply. What is the biggest potential benefit for your firm in in-house banking? 1, maximize capture of excess cash. 2, minimize number of cash transfers. 3, minimize number of FX trades. And 4, standardize short-term lending internally. Again, we'll just leave it open for a little while here. Please get any and all answers in. All right, we are closing the question. It looks like, thank you all for getting your answers in. It looks like the top 2 are maximizing capture of excess cash and minimizing the number of cash transfers. I'll hand it back over to Karen to wrap up the presentation with the last bit of content. Karen?
Thank you, Jeff. To provide you with a real example of a software solution, this slide shows an example of an Oracle PeopleSoft implementation that was performed for a client in Amsterdam with a very complex in-house bank. You can see that there are 4 quadrants to the solution. Netting is one of the quadrants. PeopleSoft, just as an example of software, provided a bilateral netting mechanism. However, we deployed a multilateral netting mechanism along the left from the PeopleSoft accounts payable by taking intercompany payables and processing them through an upload into the in-house bank. So those accounts payable intercompany vouchers created a position within the in-house bank, and it created a position for both parties involved in that payable, both the payor entity and the payee entity. In addition to that, this particular client had significant payment on behalf of functions. So since payment on behalf of is intercompany by default, that was also included into the upload process. So there were 2 major components, the intercompany payables and the payment on behalf of. Those were fed into the in-house bank, and the in-house bank created a daily position, and the daily position accrued interest at LIBOR rates, both for debit balances and credit balances. On the right-hand side of the diagram, in the cash management module and the deal management module of Oracle PeopleSoft, there were bank transfers, which were intercompany transfers. Those also created flows within the in-house bank and impacted the daily balance. All of those elements were pulled together, created the balances, created the in-house bank positions, and also ultimately fed all of that information to the PeopleSoft general ledger. In addition, quarterly interest within the in-house bank was settled using additional transfer mechanisms, which in turn created the inter-unit entries necessary to record those positions in the ledger. And just wanted to remind everyone that they should be considering the U.S. Treasury Section 385 key considerations. Elire is not a tax advisory, so we cannot answer questions today regarding 385, Section 385, but we just wanted to remind you that these are some of the key elements that you should be considering as part of planning an IHB solution.
Thank you very much, Karen. That wraps up the content of our discussion today. If you guys have any questions, we actually have seen a few come in throughout the presentation. While we answer a couple of these, if you guys have any additional questions, please, again, reminder to submit them through the question portal on the right side of the screen. So Karen, the first question that came through is actually in relation to the first poll question that we had around how the Treasury organization is structured today. And they asked, what type of structure is best, centralized or decentralized?
Centralized as to corporate operations and centralized for the in-house bank. So I talked about the IHB management being centered in Luxembourg, but it does require regional treasury centers to be out in each of the time zones for a proper transfer of funds, both sweeping funds and then performing funding and concentration transactions.
Thank you. And of course, to whoever submitted that question, if you would like to continue that conversation, we'll share Karen's contact information in a few minutes here, and we would be more than happy to follow up with some additional detail. The final question that we did see come through, Karen, asked about the availability of software to help support in-house banking.
So I mentioned during the presentation that this is a complex solution. There are tremendous advantages and savings. And after the presentation, Jeff or I can share real examples of those savings. However, it does mean that you have to scrutinize heavily your choice of software. So there are a number of packages, G Treasury, IT2 Treasury, PeopleSoft from Oracle, and also Oracle EBS. Those applications can support an IHB solution. I'm sure there are some others, but those are the ones that we're most familiar with. Oh, and in addition to that, I missed one, which was Wall Street Systems.
Thank you, Karen. So that wraps up all of the questions that we had submitted during the during the presentation through the portal. If you guys have any additional questions, please do not hesitate to reach out. But before I let you go, I do have a few final comments to leave you with today. We do have one more webinar coming up that is also approved for 1.5 CTP credits. So please feel free to register for that on your own, and do not hesitate to share this information with any of your coworkers or CTP colleagues that may be interested. This one will be covering how 4 steps will change the way you approach your TMS selection, and that is going to be on the 29th of May from 2 to 3:15 p.m. Central Standard Time. Also, Elire will be attending the National AFP Conference again this year. I would love to see you guys in Chicago in November, if you can brave the weather, for those of you that are not familiar with Midwest winters. We will be at booth 769 and would welcome connecting with any of you at the booth. On the next slide, I would welcome you to also connect with Elire on any of our social media sites. This is a great way to get real live content in relation to presentations, other marketing initiatives, white papers from some of our thought leaders and subject matter experts here at Elire, and it's a great way to connect with the team. Again, there is Karen's contact information as well as mine. A reminder, a recording of the presentation, as well as a link to register for our next webinar will be sent out in the next couple of days. And one last reminder again in regards to the attendance documentation for the CTP credits, that will be sent as well with the follow-up material. So again, thank you very much for attending this afternoon, and have a great rest of your day.
Thank you, everyone.